Good morning, everyone. This is Meherban Faroogh from the 1005th Club. Today is January 25th, 2012. Welcome to our weekly currency analysis classes. So while I'm still hoping for some of you to step up and submit your plans, I'll keep presenting as much as I can in terms of the current events / topics that we feel are significant for you to understand as traders. There's a lot of misinformation out there, we believe, and Forex, first of all, is not very easy. For those of you who've been doing this for some time, have probably figured it out. That being said, there are certain concepts that you need to understand at a very high level first before going down in the weeds. Today, what I want to present is one of such topics. So, if you've been trading currencies for any amount of time, you should know by now that interest rates, and more than interest rates, interest rate expectations is critical for a forex trader. And you would read a lot about it on the news, but over time we figured out there's a way to kind of try and properly gauge which direction a certain interest rate is going. And when I say certain, I mean interest rate for a certain currency or a country. So anyways, I'll get to that in a second. So once again, I just wanted to thank FX Trader. We're very, very, very happy for being nominated as one of the 5 people for Forex Person of the Year 2011. And we'd also like to congratulate the other 4 who are there, and all the best to them as well. So I was just very happy there, and thanks again to Forex Trader. Once again, just a reminder, the New Year special is still there till February 3rd. So you can check it out and kind of you can keep moving. So I don't think we have any trade plans. I'm hoping one of these days we'll start getting quite a few, and as I'm saying, that's essentially where I believe, especially if you're new to intermediate, I think you will tremendously benefit. Okay, let me pull that down now and start with the deck today. So interest rate expectations, in my opinion, in our opinion, it's based on one's understanding the relationship between interest rates, inflation, and growth. And I'll talk a lot about this today. So the idea is to understand interest rates expectations, and so what I'll do in the first few slides is take each topic at a time. I'll go over interest rates first, and inflation, and then growth, and then tie it all together. So if I pick up a pair like Aussie Yen, and if you looked at any of the websites, whether it's fxstreet.com or DailyFX or Forex Factory or whatever, you would see that the interest rates at this point in time for the Aussie is 4.5%, which is the highest as we speak. I think that's followed by Kiwi and so on and so forth. And the lowest up down there is the Yen, which has been lower than 0.1% for quite a few years now. Again, basic stuff. The currency on the left of the pair is the base currency. The currency on the right is the quote currency. And the idea here is if you bought Aussie Yen and you held on to it even for one day overnight, you would end up earning interest. And likewise, if you sold the Aussie Yen, you would end up paying interest. If you sold the Aussie Yen and you ended up holding it overnight, you would end up paying interest. Now, what I've just discussed is the basic concept of carry trade. This should not be any news to you, and because when you're buying Aussie Yen, essentially what you're doing is you're borrowing in the yen to buy. So you're borrowing in the currency with the lower rate of return or the low interest rate, and you're to buy the currency that has a higher rate of return. So the differential in the interest rates essentially is how you earn interest, and likewise if you sell, you end up paying. Now, the key here is to understand that where are interest rates headed. Um, as far as the best as I know, most of the times, economists and especially the forex traders, they're always trying to figure out interest rate expectations. So the idea here is if the traders expect interest rates of a particular currency to rise in the near future, they will start buying it now. And likewise, if they expect the interest rate of a particular currency to fall in the future, they will start selling it now. the the point I want to emphasize here is the expectation. So, if you have a rate announcement on the euro from the ECB at 7 a.m. whatnot, you would typically see, if you open up any of the calendars, you will see what was the announcement last time, what are they expecting now, let's say 1%, and then it comes at 1%, or previously it was 1%, and now they're expecting it's at 0.75, and it comes at 0.75, or it does not come at 0.75, it stays at 1, or goes up at 1.25, or drops at 0.5. Now, a couple of things here. If the actual interest rate comes in differently on the calendar, on the news event is announced differently than what was expected, the currency moves accordingly. So if the rate comes out to be higher than what was expected, you would see a sharp spike and the very day, and it would continue into the next series as well. If it comes below what was expected by the economists, likewise the currency would fall. If the actual rate comes out to be exactly what it was expected, in our example, if I say the economists expected it to drop by 0.75, and it came at 0.75, then more times than not, you will not see a significant jump either ways, because that's what the expectation was, and that expectation was built in the price. So pause there and think for a second. The expectation of the market or the economists or whatever that you see on those news calendar, that was already built in the price. So you ask yourself a question: what do you mean built in the price? How was that built in the price? So what I'll explain today, or hopefully try to explain today, as quickly and as simply as possible, is how is that expectation set up. And now again, the expectations change over time, but there are certain factors that would lead the market to believe that the central bank may or may not raise interest rates. And based on that expectation of whatever announcement is coming 3 weeks down the road, or 4 weeks down the road, or a week down the road, the market would start buying or selling that particular currency today, now. That's what you need to understand. So, if that logic, what I just explained, is correct, hence the key question in Forex is, how do Forex traders predict where interest rates are headed? And I have to caution here, I mean, there's no 100% guarantees, there's no whatnot, but my emphasis here once again is, if you're a student of Forex, I think you should understand this from the 50,000 feet level. If you've been trading the news, and been successful at it, kudos to you. I don't trade the news, but I keep myself very much aware of the news. So the answer to this question lies in understanding the relationship between interest rates, inflation, and growth, and that's what I'll be trying to focus today, to try and explain how this relationship works. So going forward, when you're following the news, whether it's Bloomberg, FXStreet.com, wherever, right, you are able to understand the statement that a central banker or a politician or an economist is making in context to what we discussed today. You see these terms used interchangeably quite a bit. Okay, so let's review some of the primary objectives of major central banks. So again, last night I kind of Googled a little bit, and I knew a little bit of this from memory. So the whole point here is, if I pick up the 1, 2, 3, 4, 5, 6, 7 major currencies, hence 7 major central banks. And if you went through their primary objectives, so every organization, whether it's a central bank or whether it's Citibank, has a mandate, or whether it's the government, it has a mandate, right? And based on that mandate, they run their organization, or they do things. They do things based on with the objective or with the idea of meeting the mandate, the primary objective. So if you went through the primary objective of, for instance, the Fed, the Federal Reserve in the US, they have two primary objectives. One is to maintain target inflation, and as best as I know, is to maintain it between 1.5 to 2%, which, by the way, is extremely difficult. And that goes for all the other banks too. But nonetheless, the idea is to maintain inflation within 1.5 to 2%. The other key objective or mandate that they have is to maintain maximum employment. So in the current times, if the inflation is 9% or 8.6%, whatnot, that is not maximum employment. I think there's a certain, they don't expect 100% employment or 0% unemployment, but there's a certain percentage. I may not be mistaken here, but I think that's about 4 or 5%, something like that. At which point they say, yeah, that's the best we can do, and that's maximum employment. But Fed has a dual objective of maintaining maximum employment and maintaining inflation within a certain target. ECB mandate. They have quite a few, but the primary mandate is to maintain inflation around 2%. Bank of Japan, to the best of my knowledge, they have the mandate to maintain inflation. The term, by the way, that if you Google or you went on Wikipedia or whatnot, the term you'll read is price stability. So around all these central banks, and price stability essentially means inflation, to manage inflation. So Bank of Japan has specifically not stated a target rate. I really don't know why, but that's just the way it is. But the primary objective is to maintain inflation within a certain target. I would imagine it shouldn't be more than 3%, quite frankly. 2, 3 max is what any nation can afford as a mandate. Swiss National Bank, the mandate is not more than 2%. Bank of Canada, 1 to 3%. Royal Bank of Australia, 2 to 3%. New Zealand, around 1.5%. So the idea is not to get lost between whether it's 1.5 or 2.64%. The idea for me here to explain to you is inflation is the most significant objective common across all the central banks in the world. I picked up the major ones that I'd imagine if I picked up the entire world. Across all of them, it would be the single most significant objective. Now, again, this is common sense knowledge, but if you're not familiar, CPI, or rather core CPI, is the primary gauge for inflation. So CPI, essentially, or Consumer Price Index, is a time series, year over year, essentially, measure of the price level of consumer goods and services. In my example, going forward, I'll just make a case that if I bought a computer last year for, let's say, $100, just to make it simple, and this year I bought it for $102, I paid $2 more. Over 100 last year, that's 2% inflation, just on the computer. So when you think about all the goods and services, and they have a comprehensive, the government has a comprehensive way of computing or including items for goods and services, but at a very high level, in a simplistic way, that's really what it is. How much it cost last year, how much it was costing this year, and what's the increase. Weighted average, lots of rocket science, I'm sure they do. For the purposes of Forex and for the purposes of what the heck should I be paying attention to when I look at calendar or when I read the news or whatnot, you should be paying attention to core CPI. Core CPI is by far the most significant indicator that measures inflation. And the difference between core CPI and the CPI is volatility. So core CPI excludes, as they say at least, it excludes price volatility because it excludes food and energy. So these two items, food and energy, are probably the two single most items that are highly volatile. So that's not in core CPI, therefore core CPI is used for measuring inflation. So that's basic economics, and that's something I wanted to kind of lay out there upfront. Important for you to know when you look at calendar events. The question here is, so once again, therefore, inflation is a primary objective for all central banks. So as a Forex trader, I do this, and I would suggest you do it as well. Whenever somebody lays out any information to you, a standard question that should go in your head is why? Why do I need to use this information? And the other question is the how. How do I use this information? So why do I need to use this information? Then how do I use it to make tips, essentially, right? Because, I mean, the internet and everything else out there is, you know, there's a lot of information out there. There could be information overload. And, you know, information knowledge is good. That's great. But you can end up wasting a lot of your years and time to figure out which information should I use to trade currencies. So it's good for you if you ask these questions. Why do I need to know this information, and how would I use it? So why do you need to know this information? Not the details too much, but why do you need to know that inflation is critical for central banks? Because as I said earlier, what economists and Forex traders, and for that matter, any kind of trader does, is try and figure out which way interest rates are headed. And the way they figure out is the gap between actual inflation, which is essentially the core CPI, which is why I went in a lot of detail explaining what core CPI is. It measures inflation. So actual inflation that you see on the calendar versus target inflation. So just to again be clear, your actual inflation is this statement down here. There is a target inflation, is this column here that I listed, okay? The gap, if the gap starts becoming too large, if your actual inflation, I'll start throwing some numbers out. So let's say Fed's target is to keep it between 1.5 to 2%. So if the inflation starts going 2.5, 3, 3.5, you should definitely start expecting interest rates to go a certain way. I'll cover this as I get to the relevant slide. And likewise, if the floor of the inflation target for the Fed, the US dollar, is 1.5%, and let's say it starts going 1.25, 1.75, or 0.5, going more towards deflation, you definitely start seeing certain action being taken by the Fed. Now, before the Fed starts taking that specific action, and when I say that action, I mean increase or decrease the interest rates. As Forex traders, your job is to figure out which way will interest rates go, because whichever way the interest rates go is the way the currency, that particular currency, will go. Higher interest rates or expectations of a higher interest rate will result in that particular currency going up. Expectations of a lower interest rate would result in that particular currency going down. As simple as that. Okay. So again, this video is being archived. You can pause at this point, go back and listen to what I said, and we can move on from there. Okay, it's about 7:20. I did receive a little private message. Not sure what it is. I'll try and complete my thought process on this presentation. I'll go back and listen to see what the private message is. Go ahead and make sure. Okay, so on this slide, once again, the idea is inflation is important for central banks, and the gap between actual inflation and target inflation is what traders constantly try and see and then predict based on that where the interest rates are headed. Okay, so we covered interest rates up front, the first slide, the role of interest rates. We covered inflation. The third piece of the equation is growth. So what the heck is this? And again, if you follow the news or whatever, you will constantly start seeing this word growth quite a bit. So as per Investopedia, GDP, or gross domestic product, is considered the broadest indicator of economic output and growth. So whenever you hear the term growth, immediately should think GDP. So just breaking it down, making it very simple for you. You don't have to worry about all these definitions and whatnot. Just whenever you hear growth, whether it's EU coming out and saying, oh, the growth or the austerity that's going on or that Greece has to do will affect its growth. Bottom line, you should understand it will affect the GDP. So higher austerity essentially affects growth, reduces growth, which means it would reduce your GDP, which means if if Greece is expected to bring down its debt to GDP ratio from, I think it's 160 or some ridiculous percent right now, 190, from that level to 120% in 2020, because of which it's trying to negotiate with private sector investors, take a haircut of 65-70%, bring the rates down to 3.5%, and he's going off topic. But the point you have to understand here is growth plays a significant factor as well in for the central bank in determining interest rates along with inflation. Now, so how is that information helpful for you? Well, it's helpful because if you understand that growth plays a significant impact on interest rates, and if you've been trading for a while and if you've been following the market for a while, you would start seeing a certain trend. You would start seeing what the central banks typically do when growth goes up or growth comes down, but inflation goes up or inflation comes down. You will start seeing some central bankers and politicians or their proxies start coming out and making some statements which may not be true all the time. And I say this all the time, and I do this with a lot of respect. But a lot of these central bankers and a lot of these politicians, they are salesmen. So they have to sell their product. I mean, they would rather not print a lot of money. They would rather not reduce or increase the interest rates significantly. They'd rather not do quantitative easing, whether it's ECB or whether it's the Fed or whatnot. So in order to avoid all that, they understand that the words that they speak or the words that their spokespeople speak are taken very seriously by the market. So you will see this in the news. You have to start seeing it playing out on the charts based on certain statement that comes out. And I'll talk about that a little bit as I start explaining the relationship between interest rates growth and inflation. They will downplay, for instance, and you've seen this in the past, they will downplay, for instance, the gap between the actual inflation and target inflation, saying, oh, we feel, in the next 6 months this will be covered up because of this reason. Or they may not even give the reasons. They will say, we feel it'll be covered up or it'll come back within the target. So essentially what they're saying is, by the way, PS, we're not going to increase the interest rates. So the market gets it. That means the expectations will go down and so on and so forth. The currencies move. But getting back on the subject, when you talk about growth, we're talking about GDP. Okay, you do not need to know these details, but if you're curious like me, GDP is the market value of all goods and services produced by the economy during a given period, which is typically a year. You would see a quarter-over-quarter GDP increase, month-over-month, or year-over-year, but really on a percentage basis. Whenever you look percentage basis, it's year-over-year. So GDP includes personal consumption, government purchases, private inventories, paid in construction costs, and foreign trade balance, i.e. exports and import. Bottom line is, you just need to know where the growth is going, where GDP is going for a certain country that may or may not affect its particular currency. I thought this was interesting, so I just kind of Googled and from Wikipedia, I took this snapshot. So you can see that in 2010. Now here's the interesting thing. I mean, if you looked at stats that came out from IMF versus World Bank versus someone else, you will see minor variations, okay, in numbers. Nothing significant. I think the rankings don't change, but a few thousand here and there, maybe a million here and there. My suggestion to you is don't get lost in that, right? Stick to the high levels. Focus on the subject, on the topic, and don't get lost between France numbers are different on IMF versus World Bank. What the heck is going on? Don't waste your time there. You'd rather focus more on where the trend is, what the charts are looking like, which statements are coming out, and what does that have to do with which direction the trend? Will the trend continue? Will the trend retrace? If it has retraced, does it make sense? Is it temporary noise? Do you want to make most of that opportunity because it's struck at a support resistance or Fibonacci and so on and so forth? But the thing I want to just point out here is that the European Union is which is in crisis right now, makes up 25% of the world GDP, and US is 23%, which makes up 23% of the world GDP. So between EU and US, about close to 50% is the world GDP, and as we know, it's not really in the best of its shape. So okay. So with that, we've been through interest rates, inflation, and growth. And at this point, what I like to do is to tie it all together. So inflation, once again, is rising prices. As I explained earlier, if the computer I bought last year for 100, if I buy this year for 102, that means 2%. Year-over-year inflation, right? So prices going up, prices going down. I kind of build this gauge just to make a point. So that's your zero. So if I pick on the Federal Reserve, their mandated inflation is to manage it between 1.5 to 2%. So I just want to say this again, that you can appreciate how difficult a task that would be. If you try and step yourself into the shoes of these central bankers and the amount of critique that they get, including from myself at times, some justified, a lot not. It's extremely difficult, in my opinion, to manage inflation of an entire country like the US, or entire region like the EU, etc., within a very restrictive range. There are certain tools to do that, of course, and I won't go through all of that. But I'll just focus on interest rates for now. So what you need to understand is the interest rate that's quoted, again, that we follow, that's on all the major calendar sites out there, is the overnight interest rate. So the overnight interest rate essentially is the rate, I think they call it the discount window, is the rate at which the central bank is willing to lend to a commercial bank, like Citibank, Bank of America, whatnot, for one day. So what happens is, on a daily basis, all banks balance their books, the treasury books especially, monies, deposits that came in, loans that went out, obligations, whatnot, and there's a little bit of rocket science there. And they figure out the gap, the shortfall. Again, depending on where the markets are, but they have many choices. I think one of the first choice that they have is to approach the other bank. So if Citibank is short, let's say $2 billion for 1 day or 3 days, whatnot, it'll try and cover up by calling the interbank market. So they'll call up Bank of America or whatever and see how much they can get at what prices. And again, these traders, treasury traders, Forex traders, they're in constant touch throughout the day, so it doesn't take too long for them to get that kind of funding. If they fall short, or if the rates are not feasible, and I'm sure there are a lot of other reasons that I'm not aware of, they fall short, they would approach their central bank. And when they approach their central bank to cover up that difference for one night, and then they can do it over the next night as well, I guess, the rate at which the central bank will lend to them is that overnight rate. So that is so for instance, for Australia, at this point, it's 4.5% interest rate, and that is the overnight lending rate. So if the ANZ Bank in Australia approached RBA, Reserve Bank of Australia, for borrowing 1 billion, whatever, for one night, they would get it at 4.5% annually. So you take that times 4.5%, divided by 365 or 360, whatever, and that's the amount of interest they'll have to pay the central bank. Again, all these details you didn't need to know. I'm sorry, but for those of you who are curious, I think it's good to know. So now you know this. Let's put it out of the way. What you need to know is going forward. So again, back to my previous slide, the central bank of any nation would, I wouldn't use the term manipulate, because they manage. They manage the interest rates up or down depending on where the current inflation rate is in relation to their target. Okay, so once again, coming back to the Fed, if Fed's goal is to manage inflation within 1.5 to 2%, and let's say inflation is somewhere around here, 2.5%, 3%, 3.2, above 2%, they would start raising the interest rates. That's what you need to. Once again, I'll stop and I'll repeat. If there's a gap between the actual inflation, which is measured by core CPI, as I mentioned in the first slide, and their target inflation, if it's to the upside, right? The actual is higher than the target, and that's a significantly higher, 3%. They will start raising interest rates. You can expect them to start raising interest rates. Now, they might come out and make some statements, and that statements might again diminish any hopes for raising the interest rates, and you'll see that in the news all the time. And I'm hoping if you haven't followed that before, now you will, that you have a better understanding of this. Here's what happens. Here's how the cycle happens. Now, this is in concept. And I say this in concept is because there are a lot of other factors that might come out, for instance, like currently what's going on, right? So for the last week or two, and I think going forward till February 15th is the new deadline for the Greece negotiators to figure out the final deal, going out all the way till I think it's March 20th, when their first significant payment becomes due, 14 billion euros. I think any news coming out of Greece or out of Greece negotiations or out of IIF, who are the private negotiators for the Greece debt, will have a far more significant impact than a little minor news on interest rate or inflation or even growth for that matter. Depending on as I say this again, depending on the weight of that news, depending on how negative or how positive that news on Greece debt or Greece default is, might override the calendar news around interest rates, inflation. But anyway, so in theory, in normal days, when you don't have such overriding fundamental events, when central bank raises the overnight rate, it has two effects. It affects, of course, the term structure of interest rates. Central bank raising its overnight rate would end up increasing the overall borrowing costs in the economy, number one. And number two, as we know that when you raise interest rates, it increases your exchange rate. So if Aussie went up from 4.5 to 4.75, I'm not exactly sure where it's traded, but trading it right now, but if it's at 1.04, let's say 465, the last I saw, it will start shooting up at 1.05, 1.06, going up, all the way to 1.07, whatnot. But again, other contradictory factors like Greece, whatnot, risk off, risk on, would bring it down. So overnight rate, increasing the overnight rate, and that's what my arrow is trying to signify, by the way, would end up increasing the overall borrowing cost in the economy, and it would end up increasing the exchange rate. That has two effects. So when you raise the borrowing cost, it essentially diminishes borrowing in the economy. So if you think like Walmart, if you think like Target, if you think like any other manufacturing, big manufacturing concerns out there, Chrysler, GM, whatnot, and you were about to lay a big plant somewhere in Detroit or whatnot, and the overnight rate started going up, which resulted in the overall borrowing costs starting to go up, you would probably hold on to laying more plants, right? Laying more factories. So if you stop building more factories, or if you stop making more investments in your fixed assets, that would end up reducing your production, that would end up reducing your exports. Think about that cycle, what I'm talking about. If borrowing becomes more expensive, you would not borrow. You would wait. You would not borrow. So if you don't borrow, production starts going down. On the other hand, as the exchange rate starts going up, your export starts becoming more expensive. Foreigners now have to pay more to buy your goods. Right? Keeping it as simple as that. Let's not go into too much detail. So when the exchange rate goes up, your exports become more expensive, i.e. your exports start declining. So both of these, whether you borrow less, resulting in less production, or your country's exports going down because of higher exchange rate, would end up reducing growth. Once again, we discussed what growth was, GDP. So when GDP goes down or growth starts going down, essentially what happens is the economy starts cooling down. So when the economy starts cooling down, guess what happens to inflation? Inflation starts coming down. That is the cycle. So once again, if the target rate is 2 to 1.5%, and let's say the core CPI consistently is coming at 2.75, 3, 3.25, let's say in the US, which is not the case right now, what Fed would do is they would start increasing the overnight rate. That would result overall in decreasing inflation in this particular fashion that I explained. So it will start bringing it down in the range of 1.5 to 2%. Now, the challenge always is, just like we have lagging indicators in Forex and leading indicators, but as far as the economy is also concerned, an action that the Fed or other central banks take at a given point in time, unfortunately, the results don't come out the very next day or over the weekend or over a month. It takes a certain amount of time. In the meanwhile, there are a lot of other balls rolling in the air, right? So things happen. So it doesn't always fall precisely where they want, and they can overshoot, and it can start going down below 1.5%. So let's look at that scenario. So let's say they kept raising interest rates, inflation kept coming down. They stopped, but the inflation didn't stop coming down. Inflation started going down quite a bit, below 1.5%. So started hitting 0.75, 0.5, close to 0%. Now, deflation is not good as well, right? So in that case, they'd start reducing the interest rates, which is what's happening in the US for the last couple of months, 3 years. So when the Fed or other central banks, they want to raise inflation back in that healthy range of 1.2 to 2%, they will start lowering the overnight rate. When you start lowering the overnight rate, the rate at which you lend the banks, commercial banks, two things happen. Your borrowing costs go down, your exchange rate goes down. When your borrowing cost goes down, essentially corporations, individuals, corporations who are holding back on putting in that plant, putting in more investment in the fixed assets, production cycles, whatnot, they would proceed. So when they proceed, borrowing goes up, production goes up, exports go up. When the exchange rate goes down, on the flip side, your exports go up because now foreigners have to pay less. Foreign countries have to pay less to buy your goods. Now both these end up increasing growth, right? Increasing growth, essentially your GDP, that ends up heating the economy. So when the economy starts heating up, growth starts going up, guess what happens to inflation? Inflation starts going back up. It's as simple as that. So if it's at 0.75, the overnight rate goes down, the cycle happens, inflation starts going back up in the 1.5 to 2% range. Folks, I think this is very important. It took me a while personally to figure it out, to be honest. I'm not an economist by profession. Growing up, economics was not one of my favorite subjects. Again, it was all my fault, not my teachers. But as I started becoming more astute in Forex, I started listening more and more to what Jeff had to say. I started taking a lot more interest in this relationship. Initially, what troubled me a lot, and I'm not sure if some of you are at that stage as I speak, is there are so many calendar events across so many currencies. What am I supposed to follow? at a high level, this is exactly what I explained to you. So when I talk about growth, and I'll discuss in the next slide, a lot of factors that you see, a lot of news events that you see on the calendar, whether it is the home sales or so on and so forth, has to do with growth. Core CPI has to do with inflation, right? And interest rates, of course, has to do with inflation. But I would suggest you again, don't get lost into this. But I would like to remind you that price charts, trends are created or destroyed, i.e. reversals or retracements happen because of news, because of fundamentals out there. Don't let anybody convince you otherwise. Okay. Is it possible for you to keep all the fundamental events globally that's going on in your mind into some Excel spreadsheet that pops out a number and based on that you trade? No, that's not. I'm still trying to figure it out. I haven't done it. But as you keep reading the news, just kind of follow it along with your price charts. You'll start getting a lot better sense of it. The point I want you to know is what I said up front. So hence economists and traders are continuously trying to gauge if central banks are going to increase or decrease the interest rates based on the following. So now that I've been through this in a little bit more detail, when I put the statement up in bold, you can hopefully understand where I'm coming from. So traders essentially try and continuously gauge the gap between actual inflation, which is measured by the core CPI, and central bank's target inflation rate. So once again, the target inflation rate for the Fed, for instance, is here, 1.5 to 2%. If the gap, if your actual core CPI is, let's say, 3%, the gap is 1%. So you would expect definitely the rate to start going up. And if you're expecting the rate to start going up, guess what you should do? In this case, it is the US, start buying the US. And if this is also Aussie, start buying the Aussie, so on and so forth. The other factor is the growth. High growth rate, what's happening, so for instance, China, or weak growth forecasts that are coming out, whether it's the US or the EU. But this third bullet over my years of trading and learning this market is also very critical. These are the statements that come out from folks like, used to be Trichet, now Mario Draghi, or Bernanke, or Stevens, or so RBA, whatever. So all the central bankers, including politicians, significant politicians. And I use the word significant. So Merkel, words that Merkel speak, whether it's around inflation, and lately I haven't heard her talk about that, but in the past she has. Or Sarkozy, it makes a difference. You'll see stock market going up and down. More times than not, it can also be a fake. So as you start becoming more astute, and you hear Mervyn King, the Bank of England governor, coming out and making a statement that the current inflation, we expect it to be subdued in the next 6 months. Essentially, what is telling the markets is we're not going to increase the interest rates. Now, how would you know that? You would know that if you understood this relationship. You would understand that. So he's not directly addressed. That's what I'm meaning by subtle statements. He would not make a direct statement. There are times they would. There are times they would, but there are times they don't, because they don't need to, right? Because the market understands this relationship. So again, their acceptance or denial of, and as I said earlier, a lot of it is sales pitch, so on and so forth. Okay, so that's the relationship there. One of my last slides I wanted to show you, and I'm not sure if you'll see all the things moving along because there's a little bit of delay of what I see at my end and what you would see in the hotcom room. But what I want to show you visually here is up top you have the 8 currencies. The 8 currencies. Down here you've got inflation. So imagine, let's say this was the Fed once again, 1.5 to 2%. This is the target where they have to maintain. So that's a bullseye target where they will maintain the inflation within. This is the interest rate column. So things like ECB rate announcements, FOMC minutes, the Bank of Governors speaks. So as I said, any speeches that come out, rate announcements that come out, FMC minutes, and from different central bankers and central banks. The third is the growth factor. So, as I said earlier, if you look at your calendar, a lot of what you see in the calendar has to do with growth. So whether it is a non-farm payroll, so non-farm payroll is the growth or not growth in labor. Trade balance, once again, has to do with growth in my mind. Jobless claims has to do with growth. Unemployment rate has to do with growth on the labor side. New home sales has to do with growth on the property side. Manufacturing index has to do with growth on the manufacturing side. Purchasing manager index, how they feel about how purchasing managers feel, has to do with growth. Durable goods orders has to do with growth. So if you think about that, and again, earlier I explained that growth is equal to GDP. In the end, that's what it comes down to. So if you go back and think of the definition of GDP, increase of goods and services, and there's a whole big definition of that. A lot of what you see on the calendar, whether it's around labor, or whether it's services, or whether it's around property, or whether it's around goods or factories or manufacturing, in the end, it all kind of translates into growth. Okay. When you hear things about CPI, CPI or core CPI, that has to do with inflation. And finally, interest rate speeches by central bank governors, interest rates. So if you think about, and there was no better way for me to visually kind of show this to you. So there are these two red dots. So the first red dot represents interest rates. The red dot represents growth. So the point I'm trying to make here is, and I'm not sure if you can see the ball move, but it's actually moving at this point. Interest rate keeps moving, right, in the market. Growth keeps moving up and down, and I. So if you try and visualize this, this is not within 24 hours. This is over months, over years, across different currencies. They're kind of moving back and forth. Now, as the interest rates moving, so inflation starts moving. So inflation starts going back and forth. It doesn't always stay within the determined target rate. Now again, these three keep moving because of the news events. What's going out there? Where did your core CPI come out? Where is the money supply? NFP. Oh, we lost so many jobs. Oh, we made so many jobs. Guess what? We lost so many jobs in the U.S., but in England, we made up for so many jobs. So if you think about this, I know it sounds a little crazy, but in the real world, that's how, as a Forex trader, you feel at times. It's all over the place. Between the 8 currencies, everything that's going on, the calendar on the growth side, everything that's going on the core CPI, the inflation side, what the heck will come out next? Will Mervyn King make a statement? Will Mario say something about inflation? Will Bernanke say something in the Wyoming statement is about to make? What about the FMC minutes? What did one of the directors there say? So Marcus continues trying to read that. Now, this is why I would suggest you read the news. Now, be careful. There are economists dime a dozen. Not to undermine that, but if you picked up 10 random economists, you would hear 5 say one and 5 say the other. So in the end, you kind of have to make up your mind. And the idea is follow your chart. So this is where you follow the chart, you follow the trend. You see if a certain currency is spiked up or long. You try and figure out the why. The why is very important. One of the best things that Jeff has taught us at the 1000 Pip Club is to ask the question why. Is to think why certain things happen. And that why, as you keep following it along, that's what experience is. So, folks like me can come around and share the little insight with you. But over the years, you have to build your own experience. So you have to keep asking that question why and see why certain things happen. So that's it from me. I hope you enjoyed your session today. And have a better understanding of fundamentals and how it drives the market. So I'll quickly take a look at the questions. Let me know how you found this session. Oh, thanks, Joseph. I really appreciate that. Thank you. Bookie. Thank you. This will be archived, so you can go and listen to the archive. Tomorrow, I think by tomorrow or later. And as we continue doing these classes, Wednesdays, and I'm sorry I have to say this again. I'm hoping some of you will step up in the near future and do some currency analysis as laid out on our forum. We'll talk a little bit more, in fact, a lot about what's happening on the inflation side, what's happening on the growth side, so on and so forth. There are some wonderful webinars that you already have on FX Street. There are some very good speakers there, very impressive. So if you're paying attention to what they're saying, you're in good hands. I think you do quite well. That's it from me. Maud, Vicky, Edinda, thanks a lot for all your help and support. Really appreciate. And look forward to seeing you next week, guys. Have a good weekend. Bye now.